first of two webinars on this very, very topical discussion. Bear with us while we get the slides up and running. For those who will ask, I'll preempt you by saying these will be shared after the event. You're more than welcome, as I said, to the first of these reviews on the Nigerian tax reform that are currently before the National Assembly. So we are making our review based on what is in the public domain. And of course, nobody knows exactly how representations may be taken by the National Assembly and what final changes would take place. But this gives us an opportunity to start to understand the extent of these tax reforms, which I must say are extremely welcome, long overdue. However, as with everything, the devil is always in the detail. Now, to discuss this this morning, this subject, we have two eminent tax professionals who have a vast amount of experience and much of that experience relevant to Nigeria. So we have Russell Eastaugh, who is the African lead for Regan Van Rudy, who, as you can see, their logo is on the slide along with Enowa's Alex company. So Russell has been also the head of a Kingfisher Group for a number of years. Kingfisher, for those of you who like a flutter, was one of the betting online betting companies. So he has a lot of experience, and he's betting that overall the changes will be positive for every industry. But he no longer has an interest there, and he has, of course, been a tax partner in Nigeria with PwC. He is fully Nigerian qualified, a fellow of the Chartered Institute of Taxation, and was also on the Fiscal Policy Reform Committee of the last government that led to the finance bill. So he is aware of all of the various issues that are real life in Nigeria, and I'm sure we will benefit greatly from the wisdom that he brings to this conversation. Similarly, Theophilus Ewanu is a founding partner at Alex. He's now a senior partner, and he heads the firm's taxation and corporate commerce practice groups. Like me, he has another qualification in a different part of the world. He's also a mechanical engineer. So he fully understands the reasons for technical details that we go through. But he's widely acknowledged as one of Nigeria's leading tax practitioners. He's a fellow of the Chartered Institute of Taxation, and I am the coordinating dean of the faculties of the Institute of Taxation. And he was a member of the ministerial committees that reviewed the framework for establishing private equity funds in Nigeria and reviewing the framework for the grant of pioneer status. Topics which may also be of quite some interest to some of our colleagues, as these are all up for changes. So with those brief introductions, I'll hand over to Russell and Theophilus to give us talk through a couple of slides. I will then ask a couple of leading questions, and then I would ask you to either put your hand up, put your chats, if possible, or your questions in the Q&A box or in the chat box, and we will pick these up and deal with them. This is your webinar, so you ask us as many things as you can, and hopefully some of this will get to the hearing of those who matter before it becomes law. Thank you. Over to you, Russell.
Well, thank you very much. Thanks, Mark. Thank you for the wonderful introduction, and good morning to all of our attendees. And it's good to see a good number of people coming here. And I think I'll just start with some very high-level introductory comments, partly about the changes and partly about this session. It's a lot of significant changes, I think, yeah, as we've seen. So I think that, yeah, go on here. What are we going to see is a lot of changes in income tax. I think the overarching theme I want to get across is there's some good points, there's some less good, as normal with tax law changes, but this one's quite fundamental. Yeah, Mark mentioned earlier the tax bills, the finance acts of the last few years, and they made incremental changes. This one is making huge changes. Income tax, VAT, excise, withholding, stamp duty, you name it, and the petroleum taxes as well. So vast number of changes. as well as some administrative changes, and we'll go into some of those. We're not going to get into a lot of detail in this hour, but hopefully we'll give you a flavour of what's going to go on and get you excited, or whatever the word is, about some of the things that are contained in the bill. The other caveat, of course, is the bill's not yet passed, and we don't know what's going to come out at the end of the legislative process. But yeah, we shall see. But this is an attempt to forewarn you. So I think that would be my opening gambit, that we're going to see an awful lot of changes. And perhaps we go on to the next slide, please, Candice. Yeah, the good things there, some of them, a rate reduction in CIT, companies' income tax, and a consolidation of the supplementary taxes. When I say supplementary taxes, I mean the education tax, the Neseni levy, the NIDTA levy, those things, consolidating those into one supplementary tax, which is probably one more than I'd like, called the development
levy.
Yeah, levy. Yeah, that's what I thought. It's losing my tongue. Called the development levy, and gradually reducing the percentage of that, so the overall corporate tax rate in Nigeria becomes a bit more competitive with other countries around the world and around the continent.
Yes, but sorry, Mark, but the point to be made there, Russell, is that there is some debate as to what will become of the Education Trust Fund, because it's been funding, university infrastructure for quite a few years, and education is an area where Nigeria is meant to increase how much it invests in, that sector. So this might, seem to some people as a step backwards, because if you don't invest in education, then, in the long run, 10 years from now, you see the consequences. So it's in terms of policy. I mean, this is what the words of the proposed bill say. But in terms of policy, it's something else we need to think about. Do we want to reduce the amount that's going into education or not?
Yeah, I think that's about it. I think what I see as a difference between having an earmark tax, which is what the education tax is, and spending on education, on tertiary education in particular. And the two are kind of separate. Just because you take away the body, no, you take away the tax. You don't take away the body. I don't think they're abolishing the Tertiary Education Trust Fund. It'll be funded by a budgetary allocation, and that will need the normal political arguments.
Exactly.
Which is always the case. But I don't think, frankly, I don't like earmarked taxes. I don't think they're a great policy choice anywhere in the world. And more honest thing is to have policy discussions, political discussions about what money goes where. But that's one of the things. At the moment, having a series of supplementary taxes is confusing. And people go out into the market and say, "Oh, Nigeria's tax rate is 30% on companies," and it isn't. It's around about 33 to 34%, depending on exactly which industry you're in, and before you consider distributions.
Yeah.
So that's why I welcome it. I'm sure that people who work for the TET fund might not, and the universities and other higher education institutes that rely upon it might be concerned about their future funding, and they'll have to talk to the Ministry of Education, I guess, in future, to make sure enough allocation is there. But I think as I said earlier, you don't change a tax system without creating some challenges and frankly, some losers. Overall, you've got to be looking at what is good for the country, and does this advance the country and its interests and the people in
it.
Yeah. So that was the one. Minimum tax, getting rid of that. Double tax credits. I think that there's lots of areas of the Nigerian tax system for all different types of taxpayer that were broken and needed fixed, and the double tax credit system is one of them. If you didn't tax foreign income, you wouldn't be very worried about it. If you want to tax foreign income, you have to give some recognition to the fact that tax has been paid elsewhere. And the previous system, you could have half of the tax paid in the foreign country, so long as it's a Commonwealth country, if anybody remembers where they are. Yeah. And that was it. That was a bit of a challenge, unless you're the DTA. Now, the challenge remaining is they're saying you'll be taxed even if you don't bring your money back to the country, but you can only get the credit relief if you do bring your money back, and it's through official channels. And that seems a little lopsided. Any other thoughts on that, Theo, before we move into the next one?
No, I mean, you've mentioned the challenge that will present. We don't have what for example the US has, which is worldwide taxation, which would mean that it wouldn't matter. But we don't have that. But maybe that's what the direction they want to go in. I wonder.
Well, call up the next slide, please, Candice, and we'll start seeing. And here we see, foreign dividends will be taxable, which they're not currently. And in what the legislation said, the draft legislation talks about the gross amount before any withholding taxes. So that's a starting point towards a worldwide tax system. A controlled foreign company provision, which is quite complicated, to be honest. And then a top-up tax if you've got foreign subsidiaries which have less than a 15% tax rate, and I can't see the threshold for that. So it seems to be broader than the Pillar 2 OECD idea at the 750 million euro turnover groups.
But regarding controlled companies, I mean, domestically, there is provision to tax controlled companies on, even on distributed profits. So I guess they're extending this to controlled foreign companies. I think in one of the later slides, we'll see that the test for tax residence has been expanded to include management of the company from Nigeria, even if it's a foreign company. Which has its own interesting ramifications.
Yeah, I think these are the sort of things that will make tax lawyers and tax consultants and perhaps not some of the taxpayers, because that'll get complicated. I mean, that controlled foreign company section is complicated and quite different to the ones I've seen in other countries, and it is built on that current close company law you mentioned, where the Revenue Authority can deem a dividend have been declared if it could have been declared without damage to the company's business, which gets into all sorts of shades of just what could have been distributed, and lots of arguments. So I think that's what we're seeing there. But the place of effective management test again will cause some interesting challenges, I would have thought, and that's a reasonably fundamental change. Currently, if you look for a definition of what a Nigerian tax resident is from a company's point of view, it is a Nigerian incorporated company.
Exactly.
Somewhere else, it's not Nigerian taxable unless it's unwise enough to have a branch in Nigeria, which is theoretically banned anyway. So yeah, I think that's some of the changes we're going to see. And I think one of the points I would make going forward is these are such fundamental changes. It's very hard to get an understanding of them very quickly. I've tried and I've not entirely succeeded. I think we'll find when they are legislated, there'll be flaws and more refinement and more amendments will be required. And that's normal in most countries. Tax laws get changed normally every year to try and make them a bit better and to catch up with what's happening in the economy. And I guess we'll continue to see that process that, as Mark alluded to, both he and I were involved in the past. And I think that's probably essential.
Yeah, part of it is that the entire landscape for foreign companies, including in the VAT and the imposition on trading partners in the country, the amount of administration that they have to also do to make sure that VAT is properly accounted for, withholding tax is properly accounted for, even if the foreign company has not got a significant economic presence that would have normally considered. So there are quite a number of evolving areas where the law has been changing already.
That's correct.
And we suspect they are going, this really brings a lot of those changes together very, very forcefully. And the devil is going to be in the detail. You're going to hear the words from me, the devil in the detail, quite often as we discuss. Is there anything, I mean, you have said, Russell, that the controlled foreign companies legislation is a little bit more complex than you have seen elsewhere. Is there any, and I know this is beyond NAS, but we're still before NAS, so we're talking to ourselves. But would there be a silver bullet to have run through this, or is it because it's inherently complex in the first place?
I think controlled foreign company legislation is always inherently complicated, and some of the time the complexity of the legislation is trying to make life easier either for taxpayers or the tax authority or both to take out smaller companies or ones that not big enough to be worth bothering, or where you go through all the rigmarole of trying to see what the tax bill is and then give a credit for the foreign tax and you find there's nothing left, so you want to try and get those out of the system. Now, I don't think the Nigerian one's done much of that. It's just saying, could this foreign company, well, one, is it controlled? Secondly, could it have distributed its profits without damage to its business? If so, let's deem it to have done so.
And that's a judgment call.
It is a judgment call.
That's a judgment call.
It is also quite crude, because what happens? What happens if it is fully taxable overseas? If it's got a proper business, for example. So I think it's going to involve a lot of interesting debate with the tax authority. Yeah, and I'm not sure it'll lead to an awful lot of revenue unless they find really quite simple cases. So we'll see. But it doesn't have the level of exemptions and stuff that you'd see in the South African legislation. Mark and I are familiar with the British control foreign company legislation, which changed quite radically over the years and has become a lot simpler and really looking for profits that have been diverted out of the British system. But I think the fundamental point is once you get into a control foreign company type of legislation, it's going to be inherently complicated.
Yeah, correct.
Okay. And you mentioned the effective tax rate of 15% and it being wider than the requirements under Pillar 2 of the. Could you just summarize that in one or two sentences? It's a tall order, I know, for at least so some of our colleagues can understand.
I've not met anybody who can summarize Pillar 2, but I'll have a go at it. So this is no OECD attempt to reduce the temptation to artificially manipulate your tax rate too low. And saying, broadly speaking, if you're a large company, a group of companies with a turnover of more than 750 million euro globally, then you're subject to these rules and you've got to produce some figures showing how much tax you paid in each country and what your rate was and did you have an overall tax rates of less than 15%? And if the answer is yes, either overall or in individual countries, you then get subject to some top-up taxes. And what we've seen is a lot of countries running around trying to say, well, there's going to be a top-up tax, we're going to have it, either because we're the holding company or because we're the operating company. So that's what we're seeing. This goes beyond because it doesn't look at the 750 million euro threshold. And it doesn't have a threshold at all that I can see. So it'll cause more work and more thinking. And I can see Nigerian companies with a lot of foreign subsidiaries will spend a lot of time gathering the information and showing what their tax rate is in each of those foreign subs.
Yeah, and I think it's important to mention that Nigeria actually hasn't agreed to implement Pillar 2. So this is a standalone initiative. We're not we are actually not doing this on the basis that we are required to implement Pillar 2.
No, we're doing this unilaterally and at a broader scale. So cherry picking what we like out of Pillar 2 and what we don't like and going for it. And I can see the point if they think there's a lot of Nigerian companies who've put cash box companies in tax havens, let's try and have the fruits of that in Nigeria. But it'll be much more challenging if it's a operating company in the UK, for sake of argument, which does happen, or in South Africa, where you've got quite significant tax rates and it's a real business, and the business needs the cash from the profits to reinvest.
Well, as in all cases, back to our good old vestry case, it's about shifting out the ones that are artificially inserted transactions from. It's always a very complex area, being everywhere across the world. But it is encouraging that at least some of the things we're looking wider, and some of our international partners are looking at these OECD agreements. I shall not mention the big elephant in the room, but they're withdrawing from some of these things where they realize they may not be getting a fair cut. So in some ways, it's good for Nigeria to at least have something in place that means that regardless of what happens, they get a fair cut. Or is that being too optimistic?
No, I think that's a fairly sensible point, personally. I think, that I said earlier, I think the Nigerian tax system for companies did need modernization and a bit more engagement with the modern world and economy. And this is a step in the right direction. I moaned about complexity, but I think fundamentally, if you're going to tax company profits, you're going to have some complexity. And there is an issue. Go on, Theo.
Yeah, and this is an attempt to, as you said, claw back as much as you can, because there's a fight between countries as to who takes what. I mean, that's to put it. You can put it as crudely as that. Each country is fighting for as much as it can get from the multinationals. As you said, some big countries, because of that, saying, "Well, I won't play the game if you're going to take so much out of my companies," and that's what's happening. So everybody's looking for a way to take what it can get. We now have VAT on inbound sales, things like that, which online sales, all those kind of things which didn't exist before, which means that the manufacturer or supplier might be based in Hong Kong or China or America, but he ships goods into Nigeria online, and the Nigerian government will get its VAT 7.5%, when it arrives. So
overall, I think a lot of these things are positive. Russell, were you going to go on and talk about non-resident CGT on disposal of assets?
I was going to do at some stage. I'm not sure. I could do. Yeah, I can do that. So
there are just a couple of those sorts of issues. Let me just give you a prompter, then you can sort of pick them as you want. One is that non-resident CGT on disposal of assets in Nigeria is whether held directly or indirectly, is coming into the same framework of making sure we get our share of the money. And there's also some complex, well, to me, they seem complex, especially practical implementable complex rules around the Forex rules and the deductions of conversion. I shall see if you're a better teacher than I am. But anywhere around those sorts of areas.
Let me have a go at discussing the Forex one, and Theo will join in as he sees fit and restrain some of my criticism, hopefully. Yeah, over the last couple of years, foreign exchange and the exchange rate has been a hot topic in Nigeria, mostly because it's changed so radically for the worse for the inhabitants of Nigeria. Having said which, China gets criticised by America for deliberately making its exchange rate too low. So, strong naira is not necessarily a great policy objective. But this legislation seems to be trying to restrict the use of the parallel market through the tax system. And why do I say that? There's two provisions in there. One says if you have a foreign currency denominated expense to pay, and you convert naira into that foreign currency to pay the invoice at a rate that's more than the official rate, your deduction or your capital allowances, if it's capex, will be limited to the amount converted at the official rate. So, for example, if I spend $1,000 on an expense and the official rate is 1,600, that's 1.6 million. I get the deduction for that. If I go down to the parallel market, assuming we open up a gap again as we used to have, and say it's 1,800, then I'm actually spending 1.8 million to get a deduction for 1.6. That's not too nice, but perhaps not so surprising. But then on top of that, there's a suggestion of an excise duty. And the excise duty is 100% of the difference between the two rates applied to that amount. So in this case, it'd be an excise duty of 200,000 naira. So now you've spent 1.8 million to discharge an expense which the government tells you should be 1.6, and then you pay another 200,000 for the privilege of doing so.
Yeah.
And to encourage people to take this seriously, there's some interesting information providing requirements. Anybody who has knowledge of the transaction must report it within 7 days against the threat of a big penalty. And in some cases, that penalty can include imprisonment. So there's a bit of a big stick there. So, and one of the things I've been surprised about is that one hasn't been picked up a bit more frequently, because a lot of business and a lot of individuals, for that matter, do rely on the parallel market to run their business or their lives.
Yeah.
So this will restrain their access to it or push up the cost even higher. And we'll see what effect that'll have.
Yeah, it's also going to have an impact on the fintechs, because a lot of the exchanges are now being done by small fintech banks who are using AI to mirror those minute movements and arbitrage as best as they can. So it is going to require a lot of coordination with CBN and the CBN rules. It would appear to me. Perhaps I'm overcomplicating it.
Yeah.
Sorry, Theo, you were going to say something.
Yeah.
Yeah. Well, I mean, I agree. It's a big stick, to solve the problem, and it's not actually addressing the fundamental or the root of the problem. Businesses must survive, and if they can't get FX, I mean, before a year or two ago, you had businesses which had paid for FX to their banks and had been waiting for months and sometimes years to get the FX. And somehow you expect those businesses to have stayed in business for that period. I mean, when the airlines had millions of dollars hanging unremitted, and it's not because they hadn't put the naira in the bank. And same thing with many manufacturers, and some of them had to write off, have big write-offs in their accounts because they paid naira at a certain rate, 400 or whatever, and they were told, well, those dollars you want will now cost you 1,400 or whatever the new official rate was a year ago, which meant that So that is the real problem, and nobody's thinking about how to solve the problem. They're looking at how to criminalize the activity. So people are left with little choice. You're between a rock and a hard place. So I don't know what the policy driver is in here.
Well, the policy driver appears to be to get people to stop using the parallel market, but I think that's a fairly challenging policy to try to achieve in Nigeria.
And then to go out of business.
Well, that I think.
At least what I'd say the positive coming out of this are a couple. Number one is that it is going to require that handshake to take place more actively between monetary policy and fiscal policy along those lines. And it is going to keep the focus on the fact that you do need to remove those disincentives to use the official exchange routes if you are unable to meet your business requirements. So it will be interesting to see how that plays out, especially with the criminalization and the tittle-tattle. So changed the money yesterday somewhere else, because reducing it, that's essentially what it is. Okay.
You wanted
were you going to talk about CGT as well? I have a different question.
Well, okay. I mean, I can quickly, speak about what's going to happen with CGT. There's been interesting changes over the last few years. CGT is 10%, on disposals of assets, but the idea in this new bill is to make it taxable at the rate of income tax, which is going to be 27.5%. So you're going to pay 3 times, essentially almost, what you were paying before now for capital gains. Now, with regard to, say, shares, if we remember about 3 years ago, there was no CGT on shares at all. And then CGT was introduced at 10%. Now it's going to become 27.5%. And on top of that, there's also going to be stamp duty on the share transfer instruments. Now, that's fine if you're doing a one-off transaction. If you're buying a company, you pay stamp duty on that alone, and you get your money. But what happens to people who trade on the stock market? You buy shares today, you sell in 2 weeks' time. You buy shares tomorrow, you sell in a month's time. Each time you do that trade, there's stamp duty. So that means there's increasing, friction. Your transaction costs go up. So I don't know, if they've thought about, that sort of thing.
I think on that stamp duty, the stamp duty on shares, 0.225%, I think it is, doesn't sound too much if you say it quickly. But as you say, if somebody's transacting amounts, it builds up, and it's not a tiny amount. It's quite significant, especially compared to what was there before, which was 0.
Yeah.
And if people are complaining there's not enough activity on the stock exchange already, or indeed in acquisition of shares of unlisted companies, then this will only discourage it.
Yeah.
So
it certainly has that potential disadvantage. On the other hand, it would put the toilet maker arguments of the 1960s cases, where people were clearly trying to make capital assets, revenue items capital, are all now moribund. So if you are trading even on the stock exchange on shares, you should have been paying the profit at the income tax rate rather than at a CGT rate. But it's going to change the dynamics there, positively or negatively, as we go through that one.
On that CGT, I think you're right. It'll change things quite dramatically for the Nigerian investor. I think he mustn't forget that his foreign assets are also in the scope of the Nigerian CGT.
Correct. That's correct.
Yes.
That's correct.
Also has an interesting effect for the foreigner who owns Nigerian assets. And fair enough, if he sells shares in a Nigerian company, that's taxable, but it goes beyond that. And talking about if he sells shares in a company that owns Nigerian shares, that can in certain circumstances be taxable. There's a couple of fairly complicated provisions in there, which took me a bit of time to work out what they meant. I'm not sure I've succeeded yet. But broadly speaking, if more than 50% of the value of a share, a foreign share, is derived from Nigerian immovable property or any other chargeable asset, or if the transaction would lead to a change of group structure, means control, then that would be taxable for the foreigner. So, which is a bit of a contagion continent, but it's probably not entirely welcome.
Yeah, that's interesting. We'll see how that one plays out. I'm certainly sure that my colleagues in FIRS will be smacking their lips at the potential inflow of money here and the potential discussions there. Now, I'm going to move on slightly, and I'll ask you to Theo to start off with this one. There are significant changes, or are there, to the pioneer status. It's been replaced by the economic development incentive. What are the kind of differences? Are we going to see any landscape change?
Well, I mean, apart from the name change, I think there's an attempt to move away from the the current system is there's a list and you apply, and if your activity is on the list, you get in. I haven't looked at the details of the mechanics of who can approve, in the proposal, but it used to be, a minister, sorry, the president that approved. I remember a few years ago, certain small oil companies got pioneer status approval, even though pioneer status by law only gave you exemption from companies' income tax and not from petroleum profits tax. So while that president was in power, they were allowed to enjoy it, and when the president left, they were told to pay back what they had enjoyed. So you've got things like that.
Because I did see a differential rate for if you were using also allied to pioneer status free trade zones. So a lot of people who are sitting in free trade zones but are effectively trading into Nigeria, not trading outside Nigeria. And I see there's a move in the new rules that if you're fully exporting from your free trade zone, you get a 100% relief. If you're less than 25%, I think it is. So there are changes there.
Yes, that's another area where that's been sort of, I don't know what to say, controversial. I mean, when the export processing zones legislation was introduced, 20, 30 years ago, the idea was, as the name suggests, export processing. So processing for export. And a few set up. Calabar was one of the first ones. And people, set up their businesses for export. And then, of course, as things go, in Nigeria, somebody said, but, suppose I sell some of it into the customs territory, into Nigeria, can I? What would happen? And, they were allowed to do so. And then the law was amended to say, well, if you sell, 20% or so, or, 25%, you'll still be okay. But nobody was really monitoring that. And as it is, I think some people may be selling, almost everything into the customs territory, and nobody's saying, oh, you're not going to enjoy. I mean, here we are appealing to Dangote Refinery to sell as much petrol to Nigeria as it can, and nobody's saying if you do that, you lose your exemption. Nobody's saying that because we're begging him.
I think on both these subjects, there's been some controversy, hasn't there? I mean, Pioneer's been
absolutely
controversy over the years. And I think my recollection of what I saw in the draft legislation is to reduce the number of industries to qualifying, to put a sunset on it so they'll come off after a while, and to change the existing incentive from a tax holiday and also ability to distribute without withholding tax into a tax credit for a period of years, which is fundamentally different. And I think also coupled with that, interaction with the top-up tax, which will affect both Pioneer and free trade zones. So if your company hasn't paid enough tax at 15%, and it's a large company, more than 20 billion turnover, Naira that is, or it's a subsidiary of a foreign multinational enterprise, then it'll have to pay that top-up tax, which then kind of erodes the benefits of having had the pioneer status or economic development incentive status or the free trade zone status. The free trade zones, there's been some controversy in the press over the last few couple of weeks, and I know the chair of the reform committee has been talking about it and saying it's not like it looks. He's half right, in that the law has been there to tax people who didn't export all or almost all their product anyway, but perhaps it's going to be implemented a bit more fiercely. Yeah.
As with usual, a lot of this stuff, actually some of it has existed, just not being done before. I've got a couple of questions. Sorry, go ahead, Theo.
No, I think nobody was implementing. You're right. But the big contradiction or the big debate will be, if you have this 15% minimum tax with a top-up, element, how will you situate these, companies in the free trade zone who are exporting, say, 100% and should be enjoying that, tax exemptions? I don't know that they've figured out what to do. I mean, yes, on the one hand, you want to get your tax, but you're doing this to encourage employment. Now, one is, a tax issue. The other one is a bigger issue. You have to decide which one you want. You can't have both.
I think what I think they've done is decided that most of these people are not exporting that much, and they'd rather have the tax, because they think they should have it anyway. That's my my cynical interpretation of it. We'll see some pushback. No doubt those who are already exporting will come and say, well, now you're sabotaging us. But they're large enough companies. If they don't pay the tax in Nigeria, they may well find they're paying it somewhere else anyway.
That actually leads me to Janet has asked a couple of questions in the chat box, which have got to do with cross-border issues. The first one, what are the implications of the border tax on critical minerals from Nigeria in view of the critical mineral strategy policy of the UK on critical minerals and processed minerals? I must confess, I struggle enough to keep up with Nigerian strategy. I haven't looked at the UK strategy on critical minerals, other than what's been in the press in a potential NATO country. And she's also asked a follow-up question on the competitive cost implication of our goods from Nigeria on an international market. These are all around this sort of import, export, not foreign company and cross-border taxation issues.
But is it really a tax issue? Or I think it's beyond tax. Let's take importation into Nigeria. For many years, the ports in our neighboring countries have been more efficient and cheaper to import through than Lagos port. So people go to Cotonou and to Togo, to Lomé in Togo, and bring the stuff in there, and then bring it by road into Nigeria. In fact, the joke is that at one time, I think Benin was one of the biggest importers of rice, but people said this population cannot be eating all this rice.
True.
But clearly the rice was ending up in Nigeria. But it was cheaper to take it to that port, offload it, put it on a truck, and bring it to Nigeria. Now, the ports in Lagos have known about this problem, but nobody's prepared to deal with it. A few weeks ago, they're about to introduce a 4% extra tax on goods coming to Nigeria. I don't know what they called it, some name, but when they heard a backlash, they quickly said, okay, we won't start that right away. So the costs we're talking about are not just tax costs. There are these other administrative costs, which really, they need to deal with. They're not in the tax law as we speak. They are outside of it. And if you don't deal with them, no matter what you do with the tax laws, you won't improve your ease of doing business and things like that.
Yeah, I think the critical minerals one. If Nigeria's got the minerals, then I think somebody will find a way to mine them if it's economically attractive. I don't know the tax system's a particular impediment to that. The mining tax code's fairly good. There are issues about how easy it is to get the permit and to keep it and to develop the infrastructure to get there, and maybe some things around security. Those are all broader than tax. So,
exactly. Yeah.
I think that goes for a lot of things. What I think Nigeria needs to concentrate on is how to manage the broader ease of doing business things rather than than just the tax.
Yeah,
and what we're already seeing at the moment, with that exchange rate, which people were moaning about earlier, it's making Nigeria a more attractive place to do certain types of business already, because it's become a cheaper place to do business than it used to be. And that's an advantage that people should be trying to take advantage of, and making sure the tax system doesn't get in the way, rather than necessarily trying to manipulate things like those EPZs, which I'm not sure how successful they were really in achieving their objective.
Yeah. Indeed. The tax system gets a lot of blame always for everything.
Yeah, and one thing that some countries do is to attract investors. They don't look at it from a tax point of view. They say, okay, we will provide infrastructure. So if you want to set up a factory in the middle of nowhere, they'll say, okay, you come, we'll build a road to that place, we'll build an airport to that place, whatever will make it easier for you to move your goods in and out, or move your raw materials in and out, we will do. So that's a cost to the government and not to the investor, but it certainly makes the investment decision easier to take.
Yeah.
We're not looking at things like that. Yeah, we're not looking at things like that.
Yeah, we have a bit of a chicken and egg situation where we have to get the money in to do some of those things, but we haven't got there, and it spills over wider to the general social contract.
Yeah.
I think, Mark, you had conversations about this in the past as well. Every time there's a tax incentive given to somebody's paying it.
Yes,
it's a form of negative tax. It's expenditure, government expenditure being hidden as a tax incentive, which means the rest of the population, companies and corporates, have to pay to make up the balance. The country's got to be run with something.
Yeah, that's absolutely fine. Now there is I'm into elephants today. There is one big elephant in the room, and that's the VAT. There's a lot of myth around what the changes are, and a lot of arguments around the derivation and other things that go around the VAT. But there are some advantages that the new VAT process comes in, and even I have got to get used to the fact that I will no longer talk of a VAT Act, because there's no separate act. It's within the Nigerian Taxes Act, which I think is a lot of advisors, taxpayers, and even authorities are going to have to learn a new lexicon. But apart from that, on the VAT, could you sort of give a quick run through on some of the fundamental changes that are both positive and may raise some question marks around the VAT?
Yeah, well, the issue that's been much in the news was how to distribute the VAT after it's been collected, which is not really a problem for the taxpayer. You see, I mean, I remind people of 20-something years ago, when the 13% derivation was given to the oil-producing states. It didn't impact the tax law. Tax law didn't change. It was a post-collection agreement. So it's been in the news, but we need to separate that that's a political issue from the aspect that impacts the taxpayer. So the rate is 7.5, is proposed to go up and up and up. They're saying Nigeria has a very low rate. They need to move to as much as 15 or so to catch up with everybody else. One area where there's going to be a change is input VAT. You couldn't claim it for intangibles, overhead costs, things like that. You could only claim it for tangible things, raw material, stock in trade, which meant that businesses, professional businesses, and any businesses that had no stock in trade, like a law firm, you paid money for electricity, there's VAT, you paid for paper, all sorts of things, but you couldn't deduct input VAT. But you suffered, you had to pay VAT, when you were, buying things. So now you can, build in that input VAT and reduce your actual remittance to the taxman. So on the one hand, the net remittance will go down, but the rate will go up. So whether there'll be more VAT collected, only over time we'll see how that plays. But that's one idea. The other thing is to look at, in terms of how it's distributed amongst the states, they're looking at, okay, let's see where it's consumed and where it's derived, which state it's derived in, and that state should get a bigger share. And that was what a lot of that debate was about. How to implement that in practice is going to be a bit of an interesting challenge. Not impossible, but sometimes it's easy to think that Lagos State, for example, which is a big commercial center, has many of these things already in place. The state government has a database where all taxpayers are in. You buy a car, your name goes in there, so they can actually look in their database and profile you. They can see, okay, Mark, you live in Lagos, you drive 2 cars, you have this, you live here, your tax should be about this. But many other states don't have that. So, it's how this will be implemented, in the long run, unless the states up their game, is something we'll have to see. Russell, over to you.
Yeah, I think there's been an awful lot of controversy about it, and it's mostly misguided, or at least not relevant to the average man in the street, because it's, as you said, a political discussion of who gets the VAT rather than who's it collected from and how much. I think saying it's going from 7.5 over a period of years to 15 is kind of misleading, because it's not the same tax.
Yeah.
In fact, Nigeria's not had a VAT. It's now going to have one. It's going to keep the same name, but it's not the same tax. And this thing about being able to pay input tax on almost all your costs is a fundamental difference. So I think, in my mind, a very welcome one. It has a couple of knock-on consequences. Companies will have to do a lot more work on managing their accounting system and their record flow to make sure they can justify the input tax they want to claim and those sort of things. So that's a bit of a change required. And this thing about disclosing where the sales are made to enable the tax authorities to have enough information to manage the derivation conversation is a nuisance, but it's probably a necessary nuisance. Otherwise, we're going to go back to the stages where 2 or 3 of the states want their own VAT instead of the federal one, and then nobody knows who to pay to. So I think that's perhaps a necessary evil. But I think overall the thing is a good change in my mind. And even the committee has been trying to show that the increase is not going to affect individuals as badly as they think it will, because of the price increase shouldn't be the full increase in the VAT, because the companies selling will be able to get back more of their inputs. Now, one thing that's not so great is the refund system. If you have a proper VAT system, more people want refunds, because if you've been selling a loss, if you've been exporting where you haven't got any output tax, or if you're suffering your VAT on sales by withholding because you're selling to a government or an oil company or a telco, now suddenly you've got input tax you want to claim, means going and asking for a refund. And the system's not been all that great in the past on getting refunds. I think the bill's trying to make it a little bit more robust for VAT and saying you'll get it back within a certain time frame if you ask for it. But you've got to ask, and you've got to ask within a time frame and not leave it too long. And then they've got to be satisfied, tax authorities got to be satisfied it's a valid claim. Once they're satisfied it's a valid claim, they've got a time limit on when to pay out. But that, how do they get satisfied, is still a bit of a vagueness in my mind. So I think a lot of change. I think what we've seen a number of points here, and it's not just VAT, some of these changes are very technical and will require a lot of work by tax authorities to become competent in them, and by business and their advisors to become competent in them as well. And Mark alluded to the earlier one of having to be aware where it's now no longer a VAT Act. It's hiding not in one place in the bill, but in several places. Definitions here, deductions here, penalties in the Administration Act. The sales side goes in another part of the Act. It's all over the place. So that's going to take some education, I'm afraid.
Yeah, but that raises an interesting point. In the past, companies have said, well, I have a VAT credit or refund I'm entitled to. Can I use that to pay my CIT, my company's income tax? And the answer has typically been no. But now everything is in one piece of legislation. Might that change?
I think it might, because I think they're saying if you owed a refund, a VAT refund, and we find you owe some other tax, we'll offset it.
Yeah.
Yeah, the thing that already exists, one of the finance acts allowed them to offset. So it already is in place. You can set off one tax VAT refunds against the other. The question is how to quantify what the refund really is and the process for the refund. without data, how mechanical can it be? Or do we go back and continue with the current process where you have to have a full out audit in order to make sure you're not cheating on something else before we start to give you any money back? So some of the issues that the tax authorities have to contend with are the political economy issues in the wider economy, our approach as average Nigerians, our trust issues, and how ready we are to disclose. So I see the attempt to do some fiscalization as a welcome development. That requires so many other levers to also be working. Touch wood, the technology is allowing us to continue this webinar today, but on another Tuesday, another Thursday, we might be doing back to the 1990s telephone calls. So, yeah. But there are good things in there. The positive I would take away from the VAT is it's approaching a proper VAT with an in-out. There's going to have to be a lot of understanding. There's going to be a lot of understanding of the tax officials as well, especially for companies that will be in permanent tax refunds because of the nature of the items that they're selling. And so it's going to still be interesting times as we go through all of those issues. There are a couple of comments that in the Q&A, if you could just have a quick look. It didn't flash up, but I've seen them there. Charles Iyore made some comments. If you want to have a quick look at those to see if there's anything there you're happy or unhappy with.
I haven't found the comments yet. I saw Janet's one.
No, it's on the Q&A. There are two. There's chats and there's Q&A.
Place. Okay, let's try and find it. Okay. While I try to locate that.
I think, yeah.
Where's it hiding? I struggle to find the Q&A. Oh, here we go. Q&A. No, managed to lose my screen. Yeah, the conversion to legal compliance applications, accountants, bookkeeping. Yeah, I think that's a fair comment. I think. Oh, what's happened? It's disappeared now. No, sorry, I was
generally just comments.
Yeah, I think so. So, yeah, I think if I go back to thinking about this VAT and adding your comments, I think it's going to bring more complexity, but overall, welcome. The good thing in some ways, the tax rate doesn't go up immediately, and perhaps there'll be some attempt to see what the effect is. There has been an attempt to shield the very much the poorer end of the population through enhanced zero rating of basic foods and transport, so that's probably a good thing. And I think coupled with the move away from taxing relatively poor people through the income tax system, shifting to consumption perhaps makes a lot of sense from an economic point of view.
There was a comment about Dapo that felt you had misunderstood Theo's proposal.
Yeah, I saw that. I don't know if that requires any comment. I don't know. I'm not asking a question. It's just
yeah, I think it's just a statement.
Yeah.
Okay, that's not a problem. There, we have just over 5 minutes to run through some more of our conversations. There's a question up there about limited liability partnerships that are now going to be taxed as companies. Is there any comments we want to make around that?
It's probably a fairly limited interest subject. I don't think LRPs have really taken off much in Nigeria, as far as I know. But this should probably make sure they don't, because they'll be taxed as companies and then deemed to distribute entire income immediately. So that then gets withholding tax on the entire income as a dividend straight away in the same year. So no deferral for retained income. And then overall tax rate is going to be much higher than if you were an ordinary partnership. So that's always been the concern. I think this bill is making it that bit worse. So it's not designed to encourage LLPs.
Yeah.
In fact, even worse than a company, because a company can retain income and won't pay there'll be no withholding tax until it does distribute. But in an LP, immediate deemed distribution.
Yeah, correct. Yeah.
Okay. So there are swings and flows across there. With the last 4 or 5 minutes that we do have, could I have from Theo, first of all, a couple of minutes, general overview? What would you expect people to be thinking about as we wait for what finally makes it through, whether the rates actually remain the way they are supposed to, they're being laid out, or whether there are any adjustments to those? We don't know any of those particular things, but your parting comments for a couple of minutes, please, maximum.
Yeah. Well, I mean, I agree that there are a number of, shall we say, good things, especially from the tax administration point of view. We haven't been doing very well in that regard. Of course, the more they administer effectively and efficiently, then the more pain there might be for taxpayers who have not been accustomed to doing things properly. But those who have been doing things properly should have nothing to worry about, because it's all in the books. If you have an audit, you open the books, you provide the ledger, and by the time you end the conversation, the taxman sees that you don't really owe what he thought you should pay. He comes down from his initial view to something more very reasonable, and you draw a line. It's for those who haven't been in the tax net that there'll be work to be done. Now there's a provision which has always been in the law, even before this bill, which allowed the tax authorities to see your bank account records, but it has been very, very little used. One chairman, Mr. Fowler, did use it, a few years ago, and quite effectively. I mean, he would sit down and plug into the banking system, and he could see all bank accounts of a particular BVN holder or particular company. I could then write to you and say, well, you filed returns reporting only this income, but we can see in your bank some bigger numbers. Please explain. And in addition, he was asking the banks to stop, payments, to stop that account being operated until the account holder came to explain. And that was quite effective. Many people, but I'm surprised that since then, the subsequent chairs of the FRS haven't used that power, and the provision has been repeated in the current legislation. Because if you don't have the data, you cannot tax anyone. Lagos State is very effective because it has the data. It has where you live, it has how many cars you own, so it can say to you, look, we don't think you're paying the right amount of tax. Now, if you don't do the same thing at this other level, all these things fiscalization is a way to gather data quickly, and that's, the point of it. So the taxman will see immediately how much you've sold and what VAT to expect by the first or second week of the following month. He's asking for his money. You don't have to wait for accounting to be done or returns to be filed. He says, no, I've seen the numbers. This is how much you owe. Can you send the check, or the transfer? So
Excellent. Okay, thank you. Thank you very much.
Yeah.
And Russell, I'm very aware of our countdown in the top left-hand corner.
Well, make a couple of quick comments just in closing. I think overall this is an interesting piece of legislation or draft legislation. Will make radical changes. A few things we've not talked about, like some changes in penalties, disclosable transactions, stamp duty. An interesting thing on you can pay your taxes in Naira, which has been a controversy in the past. Trying to speed up refunds, not entirely successfully. A bit worried about something. Additional assessments can be raised, not only within 6 years, but that time limit can be extended if an audit commences in that 6-year period, which doesn't look right. But overall, I think one has to take the rough with the smooth and look for what's positive in here, and hope that positive things stay in the bill as it goes through the political process, the legislative process, and remain there, and we come out with an improved tax system. Well, the start of an improved tax system. As I said earlier, I think it's got to be a continuum, and this will not be a perfect tax law at the end of June, but or indeed any time in the future after that, because never is. But there's some good stuff in here.
Excellent. Sort of thank you very much for those. As I say, an hour is barely enough to scratch the surface across the whole of the discussions. But we do have another session on individuals tomorrow, which will take another look at, because some of them issues cut across both sides, especially the use of a lot of more individuals, higher net worth individuals may find themselves being brought back into the net where they should be. But I'll part on a few thoughts. And my favorite words: the devil is definitely going to be in the detail of what comes out of the sausage machine at the other end, what the NAS finally approves, whether those rates, whether the reductions in the rates of CT actually pass with the phased timing in them, or whether those who argue for more money are going to win, or this. All of the representations is quite a wide range of representations, and there's nobody who's ever going to be happy with what came through. Another question will be, when would the new laws start to apply? Is it the date the president assents to them, or is it in line with the current national tax policy, which says that such fundamental changes should take place 6 months after the laws have enacted them, in order to allow all of the stakeholders enough time to get to grips with it? So those are some of the levels of details we don't know. We've seen these issues in previous finance acts where the start date has not, even where we had a clear start, we thought we had a clear start date. It wasn't clear to everybody involved. It also will depend upon how FIRS uses its regulatory and interpretation powers to issue statements about the practical application of some of these rules. And all of this is going to require a lot of training all around. The tax administrators are going to have a lot of mindset changes and a lot of thinking. People have got to know where the things are in the law. You see even us struggling. It's not a VAT Act anymore, so it's not that simple anymore. The question of the taxpayers need to be educated as to where they would look for information, how it would be, what would apply. There are new rules, which we also haven't mentioned, about bribing, for want of a better word, tax officials to do the wrong thing, where it exists partially in the current legislation. Again, the question is going to be how effectively that is done. All those who are advisors are going to need to review the advice they have given, and they are continuing to give, perhaps put a lot more footnotes as to what they want to say. Let's be careful about this. The courts are also going to require a significant amount of looking at some of these issues. There are disincentives to taking matters to court, the costs involved, attitudes, and so on. But we do hope that there will be somewhere, if there's a class effect, that some class actions may be taken. But all of the people in the chain are going to need to upskill, and we do hope that the process continues and further legislation is done. I just saw somebody's hand go up with a very belated. Was that a question? Was that Janet, or was that a mistake? You've got about 30 seconds. No? Okay. With that, I would say thank you very much for your time. In this 1 hour, you've been with Theophilus and Russell, experts long in the tooth, seeing most of things that can go wrong and also things that can go right. And I will summarize for them. It's a famous Parsons egg. It's good in parts, but overall, I think it's good for the country. Thank you very much, everybody.
Thank you.
Thank you.